This is the update on the payrolls report. 57K. The number for the month of June, the estimate was 113, a downward revision to the previous month as well, so a downside surprise on headline. The unemployment rate dropping back to 4.2% from 4.3%, and wages coming in line with expectations, 0.3% month over month, 3.5% year over year. Joining us now to explore some of the data and what it means for this Federal Reserve, Jeff Rosenberg of BlackRock. Jeffrey, welcome back to the program, buddy. Always good to do this with you. What's the initial response to this, and where do you think it leaves the conversation month-end around the labour market at this Federal Reserve?
Yeah, my initial response is I think this is a great report for Kevin Warsh. I think it's a good report for the bond market. I think it takes any pressure that there might have been within the committee around the peak of inflation and policy rates being too accommodative as a result, kind of pushes that story back. It doesn't eliminate it, but it gives him room, and I think Stephanie Roth had the same point, it gives him room for the decline in inflation that we see in the data that's coming through, particularly getting a boost from the oil price declines as well, but also finally seeing the declines in terms of the tariff pass through and that story showing up in the data and validating, I think, Warsh's view that we can be patient here. So this helps him to be patient. And for the bond market, Jonathan, you've already had this turn in momentum from fear of the Fed hikes to the inflation is coming down. Warsh is going to be more friendly. The momentum is towards lower rates, and I think this helps to continue that momentum.
Do you think that the market is overplaying the idea that the Fed is going to hike at all, and that, frankly, they can just remain on hold long enough for disinflation to come in enough?
I think we're seeing the market push back on the pricing of the hikes. I think that the challenge is the market is sort of dealing with the old reaction function. I felt like there was an overreaction to the dots in the FOMC statement. I think Warsh was very clear. He told us again, or hinted again at Sintra, the dots are going to go away. He used the language of, yeah, people wrote down their dots with a big pencil eraser on them, but the market is still, using the old reaction function. I think it overreacted to the dots and the surprise from there. And I think we still have to price some of that out. And I think today's data, and more importantly, the inflation data to come, is going to help to push that expectation even further out of the market.
Jeff, what's more important to you, the task forces or the earnings that we get from some of the hyperscalers in terms of the announcements of their CapEx?
Wow, that's a super interesting question. I think they operate on very different timelines. I think the hyperscaler earnings, the AI story, what you just led with in terms of yesterday's news, what we're seeing this morning in Asia, that's today. That is going to drive this market today. And those are the issues. I've talked about it before. The micro is the macro, AI in the macro data, AI in the markets. It is the dominant feature. I think what the task forces are about and what Warsh is about are some longer-term structural changes to the institution. I think it's highly consequential. I think it's very important. I think the really key objective here of removing the Fed as the prism through which we in the market view data and taking them out of that position that they've been in since the GFC, I think that's a much longer-term objective. It'll take a lot longer for that to occur. And that operates in the medium to long term, whereas the AI data, the earnings, the headlines are going to be driving the markets, right now.